we're seeing the dollar index going below the 90 levels, and it has gone and hit an over 2.5-year low. In fact, from the March peak levels, dollar index, which stood at over 100 levels in the month of March 2020 itself, has eased considerably, down close to around 12% from those levels. And some of the reasons why economists do state that we're seeing a weakening dollar is, of course, rock bottom interest rates, as well as high fiscal deficit. Pandemic has further pushed pressure on in terms of the world economies, in terms of the fiscal deficit, and US economy was any which ways earlier itself was having our high debt levels, and all these factors are leading to pressure on the dollar index. We're also seeing that there are better prospects of growth outside of the US economy, and hence the pressure continues on the US dollar. Having said that, a weak dollar is definitely good for both the EM flows as well as for emerging market currencies, and no doubt we're seeing all the Asian as well as the emerging market currencies appreciating against the US dollar from the March 2020 levels. In fact, while Indian rupee has gained only 2.7% from the March levels, we are seeing South African rand, Indonesian rupiah, Chinese renminbi, Russian ruble, Malaysian ringgit, Japanese yen, Brazilian real, all these currencies gaining considerably. And of course, South African rand, which is up 22% from the March levels, has outperformed the entire EM currency basket, followed by Indonesian rupiah, which is up close to around 16%. Chinese renminbi, Russian ruble, Malaysian ringgit, all these currencies are up anywhere between 7 to 8% versus the US dollar from the March levels, and Indian rupee and Brazilian real are up nearly around 2.7%. Now, one of the factors that economists do state that why Indian rupee is underperforming the Asian EM currency pack is the fact that we did see a good amount of RBI intervention in the currency market, and that led to a depreciating bias on the Indian rupee. Rupee, however, in recent days itself has gained to a 2-month high, and rupee is now trading somewhere around 73.5 levels to the US dollar. In fact, if you look at what Mithul Kotecha, senior emerging markets strategist, TD Securities, had to say to ET Down, he did state that he does expect further downside in terms of the dollar index. However, there is good amount of potential for the dollar index to bounce back in Q1 from the current levels. Having said that, the overall trend in terms of the dollar remains with a weakening bias, and the next big move is likely to be at 88.2 levels on the dollar index. This was last seen in 2018. According to Mithul, rupee, in his view, would have been much stronger had it not been for substantial RBI intervention, and he remains constructive on the rupee given the strength of capital inflows. He also stated that RBI may not resort to direct dollar buying going ahead and may look at other measures in terms of liquidity management. Nomura did state on the Indian rupee that in 2021, one of the high conviction calls is the fact that they expect the Indian rupee to appreciate 71.66 to the US dollar in Q1 2021 itself. The reason is the balance of flows is likely to be positive for India. Improved capital flows is on the back of a recovery in both FII bond as well as the equity inflows, and current account surplus, although may narrow slightly, we are overall going to be still having a surplus on the current account, and all these factors are definitely positive for the Indian rupee. But as of now, a weak dollar index which has hit an over 2.5-year low.